Japanese policy holds the key to global markets, not the Fed. November 24, 2025. Global markets are fixated on the Federal Reserve's next move, but Japan's policy decisions may prove far more consequential. While investors debate whether the Fed will cut rates by a quarter point in December, Japan's monetary and fiscal actions could reshape global liquidity. The long-delayed U.S. September employment report finally arrived, showing a stronger-than-expected 119,000 payroll gain, partly offset by downward revisions to prior months. Unemployment rose slightly to 4.4% as more workers entered the labor force, while the underemployment rate fell to 8%. Broader data suggests the economy is growing solidly, with GDP now tracking 4.2% for the fourth quarter. Despite the decent data, markets now place over 70% odds on a December Fed rate cut. Comments from New York Fed President John Williams, who emphasized room for further near-term adjustments toward a neutral policy stance, fueled that expectation. Williams' influential position and support from several governors mean only a few additional votes would be needed for a majority. Some regional Fed presidents, however, remain cautious about more easing. The Fed will lack fresh employment data ahead of its December 9 and 10 meeting, though it will have ADP numbers, JOLTS data, and weekly jobless claims. But the Fed is only part of the global liquidity picture. What happens in Japan has an outsized effect on global markets. For decades, ultra-low Japanese rates and massive quantitative easing supplied liquidity that kept global yields low. Strategists warn that Japan's shift away from these policies could shake markets, especially as the yen's slide intensifies. The currency recently hit 158 per dollar, near the level that typically prompts intervention. If Japanese authorities intervene to support the yen, the Bank of Japan would sell dollars and U.S. treasuries. That would effectively tighten global dollar liquidity, the opposite of what markets have grown accustomed to. Meanwhile, long-term Japanese government bond yields have risen sharply, reflecting expansive fiscal policy under Prime Minister Sanae Takaichi and continued BOJ accommodation. With hedging costs factored in, U.S. Treasuries now yield less than JGBs for major Japanese investors, eliminating their incentive to invest abroad and further reducing global liquidity flows. The weak yen has drawn criticism from U.S. Treasury Secretary Scott Bessent and increased import costs for Japanese consumers. Japan's finance minister recently signaled possible intervention, which temporarily steadied the currency. Any Japanese move to halt yen weakness could unwind years of liquidity that supported global markets. As much as investors watch the Fed, they should monitor Tokyo just as closely. By Barron's story by Randall W. Forsyth, November 23, 2025.